Physical Gold Fund presents the Gold Chronicles with Jim Rickards and Alex Stanzik. Insights and analysis about economics, geopolitics, global finance, and gold. Hello, I'm John Ward on behalf of Physical Gold Fund. We're delighted to welcome you to the latest webinar with Jim Rickards and Alex Stanzik in the series we're calling the Gold Chronicles. Jim Rickards is a New York Times best-selling author and the chief global strategist for Westshore Funds. He's the former general counsel of long-term capital management. He's a consultant to the U.S. intelligence community and to the Department of Defense. He's also an advisory board member of Physical Gold Fund. Hello, Jim, and welcome.
Hi, John. Great to be with you.
We also have with us Alex Stanzik, the managing director of Physical Gold Fund. Alex is an expert in the physical gold industry, dealing with the logistics chain from refinery to secure transport and vaulting, and he's lectured globally to investor, institutional, and government audiences on the role of gold, both in the international monetary system and in investment portfolios. Hello, Alex.
Hi, John. Looking forward to today's discussion.
Well, later in this podcast, Alex will be looking out for questions that come from you, our listeners. So let me just say that your questions today are more than welcome. You can post them at any point during the interview. You'll see a box on your screen for typing in your question, and as time allows, we'll do our best to respond to you. Jim and Alex, we've just seen a rapid and significant correction in the dollar price of gold with a small recovery over the past few days. So here's my question. Has gold reached its peak? Are we about to see a new rise in the dollar and a concurrent collapse in gold? First, Jim, maybe you could give us a macro view on this.
Sure, John. Gold, of course, as our listeners know, had been trading in a range. If you go back to last June 23rd, 24th in particular, there was a big uptick in gold. Of course, that was the direct consequence of the UK's decision to leave the EU. That was the so-called Brexit vote. And gold got a lift from kind of around the $1,260 per ounce level. At one point it was as high as $1,370. It backed off a little bit from there. But from, let's say, July 1st to September, it was trading in a range. The range was around $1,310 to $1,365. Sort of the middle of the range, or the place where it gravitated most of the time, was around $1,335, $1,340. It wasn't showing any strong tendencies to break out. It would go down and back up again. Stayed in that range, kind of centered around $1,340. Then a few weeks ago, hit an air pocket, went down to the $1,250 level, and it's been bouncing around there ever since. Let me just kind of get the exact date because I have a chart in front of me. That was September 6th. There was a break. Traded down to $1,310, but the really decisive break was on September 26th, and then it kind of went from there all the way down to $1,250 by October 11th. So that was definitely an air pocket. Now, here's the thing. I'm sure a lot of gold investors were discouraged because, particularly for those, including myself, who have been buying gold for a long time and had to live through that four-year bear market from August 2011 to late 2015. It was a long 4 years, but we saw a lot of rallies, and then they would get smashed down, then rally and smash down. And I assume some gold investors saw this recent drawdown and said, well, here we go again. You know, the whole thing was kind of an illusion, and we got smacked down again, and it'll happen again. And you know, maybe a little bit of that discouragement or pessimism crept in. I don't think that's warranted at all. I think what we're seeing is something quite different. I think it's actually not that difficult to explain. It's very straightforward to explain why I think gold will rally from here, which just to cut to the chase, makes this a good entry point for people who don't already have their full gold allocation. What happened was very simple. The market suddenly priced in an expectation of a Fed interest rate hike in December. And I think that's realistic. I think the Fed is going to hike interest rates in December. In fact, I'm quite sure of it. We had to get past that September meeting. Now no one really thought the Fed was going to raise rates in September. That was not a likely outcome. But the hawkishness of the statement and hawkishness of a lot of Fed official comments since caused the market to say, you know what, okay, they did not raise in September. They're obviously not going to raise in November. No one expects that. It's just the November meeting is just a matter of days before the election, and whatever your view on the macroeconomy or Fed policy is, the Fed's just going to keep their head down. They're certainly not going to make a big move days in front of a U.S. presidential election. So take November off the board. And that immediately causes everyone to look at December. And there the stars are aligned, if I can put it that way. The Fed is going to hike rates in December. I'll digress a little bit and explain why we can be very certain about that. But just to kind of get back to the gold story for a minute, that's what happened. Gold got repriced. In a world where interest rates are perceived to be going up and the dollar is stronger, the dollar price of gold goes down. It's not the only determinant of gold prices. There are others, and we'll talk about those. But at a very simple level, a strong dollar means a lower dollar price for gold. A weak dollar means a higher dollar price for gold. Higher interest rates imply a strong dollar. So the market priced it in, and boom, there goes gold down to around $12.50. And it has rallied back a little bit from that. Right now it's a little bit closer to that $12.60 level. So the question is, now that that's behind us, where do we go from here? That's really what investors most need to know. Gold is nowhere near its peak. As I think listeners know, they're very familiar with the math, if you will, of why gold will get to $10,000 per ounce. I'm not saying tomorrow or even next year, but sooner rather than later. We can come back to that because I know we have a question planned later in the podcast about SDRs and monetary confidence, so I'll save that for then. For right now, the Fed is going to raise interest rates in December. There are a number of conditions that were required for this to happen. A lot of people focus on the jobs report. As far as jobs are concerned, it's mission accomplished. The Fed, unemployment's down around 4.8, 4.9%. Job creation has been steady. I know the numbers, the monthly job gains are not as big as they were in recent years, but they're good enough. That's really the point. They're good enough for the Fed. We're not losing jobs, continue to create jobs. Unemployment continues to trend down. Labor force participation appears to be at a bottom. Maybe it's even going to go up a little bit. Real wages are not soaring, but they have a pulse. These are not blockbuster numbers, but they're good enough, given what's already been accomplished, for the Fed to say, okay, we've solved that part of our dual mandate. The other part of the dual mandate, of course, is inflation. They want to get inflation to 2%. They're not there. They haven't been there for 5 years. Really an outstanding failure on the Fed's part. But that looks like it's going their way a little bit, mainly because of the price of oil. Oil looks like it's off the bottom. It's kind of rallied from lows of $24 a barrel in early 2016, back up over $50 a barrel or so right now. I think there's a ceiling around $60 a barrel, but you still, you can still go from 50 to 60. And this is what Janet Yellen's been looking for. You go back over all her speeches, all her comments. She said, how many times did she use the word transitory? She said these deflationary or disinflationary pressures are transitory. Well, 3 years is a long time to be transitory, but I guess patience pays, and now we see some of those trends reversing. So the Fed can look ahead, and the Fed's always looking ahead. Yeah, we don't have rip-roaring inflation right now, but there's some reason to believe that inflation is kind of showing its face, and at least the deflationary, disinflationary trends are over for the time being. So you have mission accomplished on labor. Inflation has a little bit of a pulse. There's a consensus on the board for a rate hike. Now, remember, there have been struggles between hawks and doves on the board, not just the Board of Governors, but the Federal Open Market Committee. For several years, the regional reserve bank presidents have been a little more hawkish. The governors, particularly Yellen, from time to time, have been a little more dovish. But the last meeting, we saw 3 dissents. 3 is not Palace Revolution, but it's a lot of dissents. Those who dissented in September are certainly going to vote for a rate increase in December. They haven't changed their view. And we've seen a couple other voices come out recently. Charles Evans, in particular, president of the Federal Reserve Bank of Chicago, widely respected. One of the few regional reserve bank presidents who does have a lot of clout because he's got some pretty good intellectual chops, which is how Yellen assesses it. He said that he thinks December is the time, and we haven't heard anything to the contrary. So there seems to be a consensus on the Board of Governors. The final missing ingredient was market expectations. The Fed does not want to raise rates at a time when the market is giving it, say, a 20% or 30% probability, because that means a shock. When you have a 20% probability of something and then it happens, you've got to reprice that other 80% instantaneously. That's the kind of market shock that can get out of control. And in a fragile system, and we do have a very fragile system, the Fed doesn't want to see that. So what the Fed is trying to do, and it's working, is getting expectations up. Well, now market expectations are close to 70% that the Fed will hike rates. Now, The market's not always right about that. The longer-term expectations have been very wrong for 7 years. The markets have consistently priced in rate hikes that never appear. So I'm not saying the market's flawless, but at a short range, meaning 2 months, those expectations are important. So the Fed's saying, okay, market, you've got a 70% expectation priced in. We'd like to get that up to around 80 or 90 by December 15th. There's plenty of time to do that. They don't want to rock the boat before the election, as I mentioned, but I would expect as soon as the election's over, for that last 4-week stretch before the December FOMC meeting, you're going to hear one speech after another, and even from the most dovish voices, including Lael Brainerd. Oh, by the way, the other factor I forgot to mention was the international spillovers. Even if you think it's all signals go, in the U.S. economy, are you doing something that's going to create havoc overseas? And just a few days ago, in connection with the IMF annual meeting in Washington, they issued a report saying that emerging markets were prepared for a Fed rate hike. These things don't happen by accident, John. When the IMF comes out with something like that, that's Christine Lagarde's way of giving Janet Yellen a green light, saying, okay, we don't think this is going to be taper tantrum part 2. You know, everyone's reading from the same page of the hymn book, so to speak. So Evans is lined up. The Reserve Bank presidents are lined up. Market expectations are lined up. The IMF says, you know, emerging markets are ready for this. So all the key variables are in line, so you will get the rate hike. And the downdraft in gold was just a reflection of that. Gold was repricing a stronger dollar. Now, where do we go from here? The problem is the Fed is raising rates for the wrong reasons. And when I say the wrong reasons, the reason you're supposed to raise rates is because the economy is robust, labor markets are tight, inflation's picking up. The Fed's always behind the curve on this, and they start to raise rates as a reflection of demand for money and to kind of cool off an overheating economy. We don't have any of that. I mean, I described conditions that allow the Fed to raise rates. It's not a complete disaster out there, but this is nowhere near the kind of robust growing economy that you usually have to see for the Fed to justify a rate hike. What the Fed is doing instead is they're trying to raise rates so they can cut them in the next recession. And I've described this as hitting yourself in the head with a hammer because it feels good when you stop. The Fed's basically saying, well, normally you would not raise rates in such a weak economic environment, but there's danger of creating asset bubbles. The next recession is probably going to be sooner than later. What are we going to do? How are we going to cut rates in a recession if we don't raise them now? And that's exactly what they're doing. Now, that's doing it for the wrong reasons. You're raising rates into a weak economy. In my view, the Fed has overestimated the robustness of this economy. We are very close to a recession. We may actually be in a recession because, of course, you never know until after the fact. So what I see happening, John, is an exact replay of what happened last year. Let's go back to December 2015. We had almost exactly the same scenario where the Fed had gone all of 2015 without raising rates. You know, Wall Street thought March 2015. Then they said June, then they said September. They were wrong every time. Of course, we on this podcast were saying the Fed would not raise rates until December, and then by then it was clear that they would. The market expectations were in line, and they raised rates. What happened? The stock market crashed 11% from January 1st, 2016 to February 10th, 2016. The major stock indices were down over 11%. And what happened to gold? It went to the moon. The first quarter of 2016 was the best quarter for gold, I think, in 30 years, but certainly a very, very long time. So the Fed looks like they're going to absolutely repeat the blunder of 2015. They're going to signal that they're raising rates. Market expectations will line up. They will actually raise rates. They will find out that they're creating a stronger dollar. A stronger dollar kills exports, imports deflation, completely undoes their inflation target, imports deflation, and slows down the economy. And then the stock market is not ready for it because the market's got to reprice in not only a 25 basis point hike, but the expectation of further hikes down the road, no matter what the Fed says about going slow. So I look for, this is kind of like wash, rinse, and repeat. They are going to raise in December. That's what has caused gold to go down right now. But they're going to blunder. They're going to slow down the U.S. economy, if not put it in a recession. They're going to sink the stock market. And the reaction function will be they've got to flip to dovish. So gold will catch a bid partly as a flight to quality when other things are falling apart. And the Fed's going to have to flip to dovish to undo the damage, and that's very bullish for gold. So my immediate forecast for the next couple of months is gold's going to kind of go sideways It shouldn't go down a lot from here because it's had the repricing. It could go up on a number of vectors. There's the geopolitical vector. I mean, the U.S., Russia, and Iran are very close to war in the Middle East. The shooting has already begun. I'm sure listeners have heard about these Iranian-backed rebels shooting missiles at U.S. ships, the U.S. vessels responding with airstrikes, Russia spreading high-tech surface-to-air missiles, both in Iran and Syria. The U.S. trying to come up with some kind of no-fly zone. The Russians saying no way. U.S. planes and Russian surface-to-air missiles operating in close proximity with no clear rules of engagement. And then let's not forget our friend Donald Trump. I mean, I know that probably most people, certainly the markets and the betting odds, think that Clinton's a shoo-in. I don't. I don't know who's going to win the election, but I think it's going to be a lot closer than the market expects. And Trump, whatever else you may say about him or think about him, has had a kind word for gold. So, I mean, we're talking about gold in this podcast. I don't get into politics, but I do get into markets. So a Trump victory would be extremely bullish for gold. Any flare-up in the Middle East, not good for the world, but also good for gold in terms of a flight to safety. And then even if those things don't happen, gold, I think, goes sideways until December. Then the Fed blunders. They have to flip to dovish probably early next year, and then gold's poised for another major leg up. So short answer to the question, it's nowhere near a top. I don't think this is the beginning of a bear market or a correction. It was a one-time repricing to reflect increased expectations of Fed rate hikes. Those hikes are going to be self-defeating. The Fed's going to have to reverse course, and then gold's going to head up from there. So for those who are not fully allocated or haven't invested in gold at all or wondering if they missed the boat, this is a great entry point.
Well, thanks, Jim. So, Alex, we've heard Jim's analysis, and now I'm curious to know what signals you're picking up directly from the gold markets themselves.
Well, in regards to gold, I concur with Jim. I think this is a short-term correction. I don't think this in any way signals gold is going into some kind of a new bear market. This correction is both normal and healthy. The run-up to the high this year was very fast-paced, and I think sentiment needed the adjustment. So let's talk about some important basics here. First of all, many people focus on the U.S. dollar price of gold, but we have to remember that gold is quoted in currency pairs in many currencies globally, not just the U.S. dollar. So what I mean by that is, for example, U.S. dollar gold or Indian rupee gold or Chinese yuan gold. These pairs show that buying power measured in government-issued currency units, in other words, dollars, etc., is fluctuating all the time. And some of these currencies are getting stronger and some of them are getting weaker. And so far this year in 2016, even with this correction, gold is still up 18.2% in U.S. dollar terms. In Chinese yuan terms, it's up 22.3%. In Indian rupee, it's up 19.2%. In the British pound, it's up 42.3%. So even though we've had a correction, I'd say that so far this year, gold still performed quite well. And I'm going to add here in terms of gold price, there's a difference. There's two different terms sometimes that I hear in the industry. One is the gold price and the other is the price of gold. And I'd point out that the difference between the two is the gold price is the price reflected of what's happening in the futures markets. And the price of gold is what you actually have to pay for physical gold versus a futures contract. So moving on, speaking specifically to the U.S. dollar gold price, U.S. dollar gold, as Jim mentioned, is largely influenced in the short term by interest rates. It's also influenced by U.S. dollar strength and on occasion geopolitical events. We all know, for example, that with Brexit, gold had a big boost. At the end of the day, there are other factors and short-term swings that are driven mostly by speculation. However, over the medium and long term, prices are driven by the overall narrative, mostly of the West, on where they think the world is heading. So aside from strong short-term drivers in price, the physical market, which is what I pay attention to quite a bit, is largely affected by the availability and flows of physical gold in what we call the float. And we've mentioned this before on this program, on this podcast. Jim's talked about it before. The float includes, in theory, all of the above ground gold in the world. So by widely accepted measures, we're talking some 180,000 tons or so. It's basically enough to fill an Olympic-sized swimming pool. A lot of this gold is accounted for, and it's held by what we call official gold. So these are held by central banks, etc. Quite a bit is in the form of jewelry. For example, in India, There's something like 22,000 tons of gold in the form of jewelry in individuals' hands. Likewise, in China, there's something like 10,000 tons. And around the world, there's quite a bit held in jewelry. But any analysis of the physical gold markets that does not consider above ground stocks, which could become available for sale, is leaving out a really important factor, in my opinion. There is substantial amounts of gold that could become available to what we call the float, depending on both price movement and psychology. And these are two different things that are very important. If the price is rising, some holders of gold who bought at lower prices might be willing to sell their gold back into the market and book some gains. We can observe this, for example, by the amount of scrap that becomes available in the float when the price rises. Some people sell off what some of my colleagues refer to as grandma's gold, or old jewelry, so to speak, lying around that isn't really being used and might fetch a good price if the price is rising. This is normal behavior when markets are stable. It's when markets are uncertain that psychology may shift to a mindset of protection. And that's exactly what we're seeing today because of things like the ongoing sovereign debt crisis. We've got demographic trends that are worsening a collapsing tax base already. We've got perpetual zero interest rates or worse. Much of the world is in negative interest rates. Some analysts and money managers are saying that we've got a gigantic bond bubble going on right now of historic proportions. Some governments are now resorting to 50 and 100-year bonds. And in short, I think the psychological tone of the market is shifting towards protection. And this lowers the chance that already owned investment gold, part of this 180,000 tons we've been talking about, will be made available to the float for sale. And this increases the chances of strong pressure on the physical market during periods of demand. Now, one really interesting thing that has occurred with this correction that I don't recall ever seeing before is that normally when you have corrections and pullbacks in the price, futures and spot prices should equalize with physical market flows through arbitrage. So if you think about the large gold funds around the world, some of the largest, for example, like GLD, just as an example, what they do, the bullion banks arbitrage the amount of physical gold that's held in that trust based upon the price of gold, and they're making a spread in between that arbitrage. And what's happened is that even though we've had a $100 roughly price correction from this year's high, these inventories are actually growing right now. I've never seen this so far, and I've been in this industry for a very long time, and I've observed these funds ever since they were launched. And I think that what this means is that the bullion banks are positioning themselves for what they think could be more demand moving forward. There's three what I call demand spheres in the physical markets, and what we do is we measure where gold is flowing around the world according to the float. You've got the West, which is the biggest influencer. That's the first demand sphere. That consists of America and all of the Western financial markets that often cue off of American financial analysis. You've got China, and then you've got India. So for the West, it's been the biggest influencer on the gold price this year. There's been net inflows into gold funds in the West of over 300 tons. This is equivalent to some 12 billion plus in US dollars. China's been a strong buyer this year, as it has been for a number of years now. They're nearing 1,000 tons. They're off by a small percentage of what they normally do annually, but they're still a large factor. India, however, is off by quite a bit this year. India's gold imports this year are off by almost 60%. So by this time last year, India had already brought in 658 tons of gold, whereas this year they're only up to 270. So what that means to me is I would say that prices have moved impressively this year, even with India being off by more than half. But remember also that it was only recently that the Chinese were allowed to buy gold by their government at all. There was a long period of time where it was illegal for the Chinese to buy gold. And I guess my last point I would like to make with that, again, kind of taking a forward-looking view, is that imagine what it would be like if China, India, and the West were all buying at the same time.
Wow, Alex, that's a deep analysis. Thank you. Very informative. You have been listening to the Gold Chronicles with Jim Rickards and Alex Danzig, presented by Physical Gold Fund. Recordings can be found at physicalgoldfund.com/podcasts. You can register there for news of upcoming interviews with Jim Rickards and other world-class thinkers.